Hi, and welcome to this episode of the Insurance Experts. It's my pleasure to have Dan Dilella on the line. He's a life insurance specialist. He's works for Hoteling Group. Thanks for joining us today.
Hey, how's it going, Mark? Happy to be here. Thanks for having me.
So you have a very unique background in terms of how you got into the life insurance space. Can you tell us a little bit more about how you found it as a career?
Yeah, so started playing college football, played with the Jets for about that long, and just really wanted to kind of take something that had the intangibles part of sports, that hard work, that drive, the ability to be part of a team, work with people, and try and find that in the working world, and successfully did.
That's cool. And then how did you find the life insurance space and your passion for that?
I really just wanted to get into something with finance. And I happened to run into somebody from MetLife, and that was kind of my first stepping stone. So spent a little bit of time there, and then, got connected with my now partner, but previous boss, Bobby Hoteling, who owned the firm. I found out about him. He was a top 100 life insurance guy in the country. Snuck into his Christmas party, asked him for a job, and then showed up at his office every day for 2 weeks until he hired me.
Persistence pays off.
So it worked in that case.
So Hoteling Group, and now you're managing partner. What exactly do you guys specialize in?
Yeah, so we're basically a risk management family office. My specialty is in the high-end life insurance, tax mitigation, estate planning for business owners. But we also do, employee benefits, property and casualty, commercial and personal. So all things insurance, not, doing any investments.
Very cool. And I know, I'm a long-term care specialist. We work with business owners with tax deductible solutions. So I was really intrigued when you shared with me an idea in the life insurance space. So tell us a little about the restricted property trust. What exactly is that?
Yeah, so the Restricted Property Trust, or RPT, essentially is a program that's been around for 20 plus years, has a 100% track record with the IRS, not a listed transaction or anything. But that allows a business owner to put away money for just him or herself. That's going to be 100% tax deductible to the entity. And this could be in addition to, above and beyond any kind of retirement plans without changing those. But it allows for complete flexibility. So, if me, you, and Joe Smith here were working together, he could put away 100,000, I could put away 50,000, and you could say, I don't want to participate. So it really allows a business owner to fund stuff for themselves, but also be able to put away things for just themselves without having to offer to the employees.
Yeah, and I know business owners are being bombarded with a lot of different tax mitigation strategies, whether it's on the investment side or on the insurance side. But it sounds like this differentiates itself because you can just pick and choose who you want to offer this to. Is that correct?
Yeah, exactly. A lot of times business owners with traditional plans are saying, hey, if I want to do something for me, I got to put away 20 or 25 cents for my rank and file employees. It becomes expensive to save. Or, they might be age tested where you have one partner who's very old, one partner who's very young, and then it's different formulaic approaches. So this just kind of allows everybody to decide whether they want to participate, at what amount, and kind of gives that partner flexibility.
Okay. And what kind of gives rise to the restricted property trust or RPT idea? Is it specific to life insurance, or is that just for any asset and you happen to use life insurance as the vehicle to utilize it?
Yeah, for this particular program, it is for life insurance. But basically, like the code section, or the tax deduction that we're getting it from, is called an 83B election, which is very familiar in corporate America. It's, hey, you work for Google, here's 1,000 shares of Google stock. You're going to pay taxes on the stock today for the fair market value. But as long as you're vested for 5 years, you can then take the shares out at that period of time. We're kind of doing the same thing, just with cash value life insurance. And that's really kind of been the genesis for it, as well as, under the new administration, that taxes are presumably going higher. More folks are looking for ways that they can mitigate their taxes moving forward.
I see. And then you're also taking a deduction, and that owes itself to the life insurance rules. Is that correct?
Yeah. So when we put something in, let's say client puts in 100,000 to make math easy, it's going to be a 100% tax write-off at the business entity level. And that's because what we're taking a deduction on by funding whole life insurance is the fixed mortality and expense charges that are tied to that base contract premium inside the contract. So that is a fixed and finite number that's part of, the insurance carrier's black box that makes up whole life. But that is what we're taking the deduction on in that sense.
Okay. And so you're trying to find a particular life insurance need also for the business. So what types of life insurance needs are you typically working with your clients?
Yeah, so it could be buy, sell, key man, me and you are partners. Instead of funding something with term that, maybe has a claim paid out at 1% chance, we want to do something that's going to be more like a deferred compensation. As
Okay.
well as, it might just be tying us together because we're making that commitment for a period of years that, hey, we're bringing a new doctor on as the partner. We want to make sure everybody's putting their money into a pool that kind of keeps them here, keeps them homebound.
Okay. Yeah. Give me kind of an example. I know that you have several types of groups that you work with. Anyone come to mind in terms of a recent case study that we can use to describe
Yeah.
how it works?
So we had a great medical group out of New York, and just kind of how the functionality on this works is, let's just assume folks are at a 50% tax bracket to make it easy. If a client puts in $100,000, it's going to be deducted at the entity level, but about 30% of what they contribute or whatever goes in towards the paid up additions in the whole life is going to flow through to the individual. So if I just took $100,000 out of my business, put it in my pocket, I'd pay 50,000 in taxes. If I put 100,000 into the RPT, I'm only recognizing 30% of that taxable income. So at a 50% bracket on 30,000, I'm only paying 15,000 in taxes. So net, every 100,000 I put in, I'm saving about 35 to 30,000 in taxes, depending on your state. So we had a medical group in New York that had about 12 different partners. They were trying to figure out a retirement plan, and they just couldn't really get their heads around it. They couldn't figure out what made sense for everyone. And we were brought in by the CPA to kind of share a strategy that allowed that flexibility. So where the 12 partners were kind of arguing about it, we came in and said, hey, we could provide an offering that everybody has flexibility, the amount they want to put in, the amount that they don't. And we worked with the CPA to really kind of come up with a true strategy where out of the 12, 4 decided not to participate. We had 8 participants. Of those 8, 4 did 200,000 each, 2 did 200,000, and 2 did 50,000. So it removed a situation where they've done nothing for 2-3 years for lack of communication, lack of ability to find something. Now they're doing something that's mitigate their taxing, putting it away. And then we're also using that as key man for some of the lower partners and buy sell for the higher partners.
That's awesome. This is obviously a pretty advanced strategy. You need to understand the life insurance market. You need to understand the tax laws. I'm sure there's different rules about how to set these up, and you're working with their CPAs and with high net worth individuals. So I'll give that disclaimer, but it's really interesting. I think very few people probably know about it, and obviously
Sure.
they can do a comparison. Are the tax savings on the life insurance vehicle? How does that compare to the retirement planning side? What are the pros and cons? But there's certainly a target market out there that's really going to benefit from knowing about this.
Exactly. And that's really kind of what we're looking at is we're looking at for those business owners that have said, hey, we're coming up on April. Our CPA is going to tell us what we owe in taxes. What can we do to get ahead of it next year so we're not getting crushed? And, compared to a taxable investment, it's kind of like we're using very boring whole life, but because of the tax mitigation, it's comparing to a 7.5 to 8.5% taxable rate of return. So, to use boring whole life that's been around since 1850 and hasn't really changed too much to get a 7.5, 8% non-correlated, return, I think that could be beneficial, especially in today's market with, crazy valuations and a little bit of, froth, you could say.
Right. Awesome. Well, thanks for joining us, for sharing your knowledge here, and hope to have you on future episodes, Dan.
Perfect. Thank you so much for having me. Hope this is helpful.